Welcome to the deep dive. You've brought us a fantastic stack of source material today, and it's all focused on, well, the ultimate long-term strategy.
It really is. We're looking at the wisdom of one of the world's most successful investors, Warren Buffett.
Right. And this is a deep dive into simplicity, which I love.
It's great because it's a shortcut to being really well informed. We're looking at Buffett's core ideas for, the two questions that just paralyze everyone.
Every new investor, for sure.
New and old, I think. It's which fund do I actually pick? And then the big one, when is the right time to get on the market?
So our mission today is to unpack his very precise, very actionable advice on picking an index fund.
And we're also going to dissect his surprisingly harsh rejection of market timing.
Yeah, all the usual metrics. And then finally, we have to confront this pretty high-stakes warning he and Charlie Munger gave about what could happen to long-term returns. Okay, let's unpack this. The foundation for all of this, and it's from a 1996 annual report, which is amazing.
Still so relevant.
It's so relevant today. He says, for most investors, the best way to own common stocks is through a very low-cost index fund.
Simple as that.
But, that still leaves you with the decision. There are thousands of index funds out there. What criteria should you actually use?
Buffett's criteria are, it's a great example of his discipline. He just boils the whole process down to two non-negotiables.
Okay, what are they?
The broadest possible exposure you can get and the lowest possible cost.
Let's stick with that exposure piece first. He gets incredibly specific, doesn't he?
He does.
He recommends a very broad index, and he explicitly names the S&P 500 as the ideal choice for, the average American investor.
And that specificity, it's really a philosophical stance. He's saying, bet on America's ingenuity.
Right.
I mean, the S&P 500 is the 500 biggest companies in the U.S. So by owning it, you're saying, I think the American economy will do well over the long haul, but I have absolutely no idea which specific company is going to win.
But wait a second. Someone listening might ask, why stop there? Why not a total global stock market index? Isn't just the S&P 500 a bit of a concentration risk? You're ignoring the rest of the world.
That's a fair question, and it gets to the temptation he warns you about.
Okay.
Buffett cautions against trying to get too clever with diversification, like trying to shift between small caps and large caps or picking specific foreign countries. He says the moment you start doing that, you've left passive indexing behind.
And you're playing a different game.
You're playing a game of active speculation, a game he says you are just not equipped to play.
That's the beautiful thing about the index philosophy itself. It's an active choice to admit you don't have the same knowledge as the pros.
Exactly.
The index fund is like a safe harbor built on that admission, that intellectual humility.
It's a vote of confidence in the whole market, but it's also, an admission of your own limits. And if the index is already chosen, let's say we all agree, okay, S&P 500,
right?
What really separates a good S&P 500 fund from a bad one?
And that's where the brutal simplicity of math comes in. Buffett is crystal clear on this. Since all the funds are buying the exact same stocks, the only thing that's different is cost. He says be extremely careful about fees because your net results are what matter. It's just a matter of math.
It sounds so basic, but it's the thing people miss most often. If one fund charges, say, 0.03% and another charges 1.5%.
A huge difference.
Well, over 30 years, that extra 1.47% is it's compounding away from your money. It's this friction, this drag that just cripples your final wealth.
And so many of the big institutionally managed funds, they charge these high fees for what is basically the same product.
So their gross results might look similar, but the investor's net result is just so much worse.
Which is why he was such a big fan of John Bogle, the Vanguard founder.
The champion of low cost.
Yeah, Buffett's recommendation is to just go read Bogle's books from the late 90s.
Yeah.
He says they're all you need to know. It's about cutting out that middleman's bite.
Absolutely. The whole point of the low-cost index approach is to maximize compounding by getting rid of that constant financial drain from fees.
Okay, so we've settled the what? A broad, low-cost index like the S&P 500. Now for the question that causes all the anxiety, the one you were really focused on.
The timing question.
The timing. How do you handle high market valuations? The original question came when the S&P 500's PE ratio was way above its historical average. So what benchmark should you use? Do you wait for the PE to drop?
And this is where Buffett gives the answer that just crushes anyone looking for a simple formula. He says flat out that he doesn't think there are any great criteria for timing the market.
He specifically rejects the tools that, almost everyone uses. Retail investors, even some pros.
Precisely.
Yeah.
He just dismisses the conventional wisdom. For example, the PE ratio, price to earnings, that's the classic one people use to decide if a market is cheap or expensive.
Right.
He also throws out price to book, price to sales. He says none of them, as a single metric, can tell you if it's a great time to buy stocks.
And for anyone who's a bit newer to this, why do people usually look at those metrics first? What's the appeal?
Well, the appeal is that they promise to be a quick measure of value. You know, if the PE is low, the theory is the stock is undervalued. Investors love them because they promise a simple rule: wait for the number to hit X, then you buy.
But Buffett's argument is that they just don't work anymore, not as a precise timing tool.
Exactly. He stresses that it's just not that easy. You can't get the answer from a magazine or from watching TV. He says it's a more complex business than that.
He says it couldn't be that easy when you think about it.
Yeah, and with, the global nature of business today, and especially with interest rates being so low for so long, it just undermines the simplicity of those old metrics.
So if the metrics don't work,
Mm-hmm.
if we can't rely on ratios to tell us when things are cheap, what's the actual practical strategy? How do you put your money in?
Do you wait for a big crash?
Yeah, do you just save up a huge pile of cash and wait for a 20% drop?
Nope. His strategy completely removes that psychological danger. It's dollar cost averaging, a DCA.
Right.
He says you should consciously avoid tossing a chunk in at any one time. Instead, you commit to investing over a long, long period, 20, 30 years in, relatively equal amounts.
And you do it no matter what the PE ratio is doing.
No matter what.
That's the ultimate defense mechanism, isn't it?
Yeah.
DCA protects you from making what he calls an implicit bet on timing.
It does. If you put all your money in on one day, you are making a massive bet that the next day isn't the absolute peak of the market. That's just speculation.
And the conscious recognition that you don't know how to time the market is actually what saves you.
That's it. By investing steadily every month for decades.
Yeah.
You'll buy when it's high, you'll buy when it's low, and most importantly, you're always in the market. You're never sitting on the sidelines. DCA is the behavioral fix for an intellectual problem.
For a young person saving over 40 years, this just makes the job ridiculously simple. Pick the S&P 500, keep costs at basically zero, and invest every single month, no matter what the news says.
And that profound simplicity brings us to the third critical part of the sources, and this is the cautionary tale.
Okay.
The discussion moves to the big worry. What if index funds become so expensive that future returns are just really, really low?
This is where Buffett's tone shifts a little bit.
Yeah.
It's a bit more sober.
It does. He admits he didn't think he'd live long enough to think that was likely to happen, but looking at the valuations at the time, he said, yeah, it might.
And he paints a picture of what that would look like.
He paints a scenario where stocks reach this sustained, historically high valuation level. And in that world, your returns might only be, say, 3 or 4% a year for a very long time.
Which, compared to the historical average of 8 or 10% from the S&P 500, that sounds pretty disappointing.
It does sound poor.
Yeah.
But the critical context, the reason that 3 or 4% might still be a win is you have to ask, what are the alternatives yielding?
Right. If stocks are only giving you 3%, what is everything else doing?
Exactly. And Buffett implies that if stocks are that high, it's usually a symptom of something much bigger. Extremely low interest rates everywhere else. If your cash and your bonds are giving you close to zero, then 3 or 4% from a diversified index fund is still the champion.
And to really hammer that point home, his partner, Charlie Munger, jumps in with the ultimate cautionary tale.
The Japan example.
Yes.
Munger points out that Japan went through this exact scenario. Over a period of about 13 years, the return from owning their big stock index was actually negative.
That's a truly sobering thought for a long-term investor.
It's terrifying. A negative return over more than a decade. But Munger immediately gives the context that kind of saves the whole idea.
Okay, so what was the choice for investors in Japan during that time?
The choice was owning an index that lost a little bit of money, or holding your cash in a bank or in Japanese government bonds that were yielding somewhere between 0 and like 1.5%.
So if inflation was even slightly positive, you were guaranteed to be losing purchasing power with cash or bonds.
Guaranteed. So if interest rates on everything get really low, it just means we're living in a different world, a different universe than the one 20 or 30 years ago when, capital was paid a lot better.
So the takeaway isn't that index funds are suddenly dangerous?
No, not at all. The takeaway is that we might need to adjust our expectations of what a successful return even looks like. In a sustained, low-rate world, the index fund still wins the race even if the finish line is a lot closer than it used to be.
So what does this all mean? I think this deep dive shows that index investing, at least through Buffett's eyes, is so much more than just picking an asset.
It's about committing to a philosophy.
Yeah, a long-term strategy that protects you from yourself, from the impulse to speculate and the fact that you just don't have specialized knowledge.
We learned the criteria are simple.
Yeah.
The S&P 500 is the go-to, and low cost is it's mathematically essential. And crucially, that consistent investment over time, that dollar cost averaging it, beats trying to find the perfect moment.
And finally, we did confront that difficult reality, that future returns might just be structurally lower. We heard the warnings of low single-digit returns, maybe even negative ones like Japan saw.
And that leaves us with a provocative thought for you to sort of mull over as you build your own strategy. The Japan example forces this almost existential question on this.
Right.
If all forms of capital, stocks, bonds, cash, if they all start yielding minimal returns for a really long time, does the very definition of a good investment just shift downward?
Are we entering an era where investors have to redefine what success is?
Maybe. Is just beating cash and inflation by a couple of percentage points the new standard?
Yeah.
It changes the whole game when getting 3% is considered a big win. Something to think about as you stick to your plan.